Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In this fourth part of the Scalping series, we'll focus on two things: the indicators that help us read intraday market structure and the indicators that help us identify short-term trends. In total, we will cover 5 key indicators, some familiar, some less common, and some that can get quite complex. But through all of them, our aim remains the same: to find more reliable ways to identify intraday trends and the points at which those trends may begin to turn. So without further ado, let's get started. Disclaimers first. The idea and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented here are meant to explain market behavior, not to suggest that similar outcomes will occur in future. Outside of the risk disclaimers, note that this episode is data heavy and may need you to pay close attention to the numbers to make any sense of it. Lastly, I would be using third-party tools like TradingView Premium to demonstrate the custom indicators that we would be referring to in this video. With the disclaimers done, let's get started. Since today's episode is about indicators, I want to start by highlighting 2 key issues with any indicator. First is, describing past is not the same as predicting future. I'm reminded of Taleb's idea of the Ludic Fallacy, the tendency to assume that the future will unfold like the structured patterns of the past. This is often the trap we fall into with indicators. They can give us a sense of order and sometimes even a false sense of certainty and security because they are built on what the market has already done. But all that an indicator does is to measure the market's footprint. It cannot tell you where the next step will be, and that's an important distinction. You see, a good description of the past is not the same as a reliable prediction of the future. Just because you went to the gym twice last week doesn't mean this week is going to be the same. Okay, bad example, but you got what I mean. So, indicators can help us make sense of what has happened and at best help us think in probabilities about the future, but they cannot eliminate uncertainty. The second is the problem with averages. A lot of indicators we use are built on some form of averaging. As Steven Stigler, the historian of statistics, has pointed out, averaging is one of the most radical statistical operations ever devised. And I think that's absolutely true. It's simple, elegant, and incredibly useful for making comparisons and spotting trends. But it also has its downsides. An average is only a representation, not the thing in itself. And depending on the context, it can introduce lag, which means the indicator may react only after the market has already moved. And on shorter time frames, that can be a big issue. So now that we have a sense of the inherent shortcomings of indicators, let's move on to understand the 2 types of indicators we would focus on in this episode. The first type are the ones that help us understand the market structure, and the second type is the one that would help us identify the trend and the turning points of a trend. To make life easy for you, the code snippets for all the custom indicators that I show in this episode would be available on the Substack post of this episode, which will be up in a few days' time after the video goes live. The link would be in the video description. But fair warning, indicators are not the holy grail. Lastly, all charts that you would see are of Nifty 50 spot and are on a 3-minute time frame. Alright, let's start with the first indicator. The first indicator that we will talk about is the intraday range indicator. It's nothing but a comprehensive live intraday market structure statistics calculator. It's a custom indicator. The purpose of this indicator is to tell us how the day is evolving in terms of range. As you can see in the table, there are a few metrics that we would need to keep an eye on during the day. The first metric over here is the session range, which is nothing but the high minus low calculation, which is actively calculated all through the day. Depending on at what time of the day you are looking at it, it'll tell you the high minus low value at that point of time. Right now, the markets are closed and you're seeing 380.5, and that's the range for the day. Next to it is the average 5-day range. So what that does is it calculates the high-low range for the past 5 days and tells you what percentage of that is today's range. So today's range is 104% of that, which means today's range is greater than the 5-day average range. That's exactly what the next row, ADR progress, also tells us. The next set of metrics that you see over here in the table is what I would call the range by time metrics. S1, S2, and S3 are the 3 time segments. And what you see under the value column is the range for that time segment. S1 range today was 347.6. On an average, it's 238.8. If you look at the 5-day average, so today's S1 was 146% of the 5-day average. And then S2 range was 380.5, and there was a range extension of 32 points in S2. So there was a 33 point approximate range extension in S2. And that's how range became 380.5 from 347.6. Now again, the 5-day average of this segment was just 252.7, and today's S2 range was 151% greater. Talking about the S3 range, again, there was no range extension, and hence the S3 range remains at 380.5 with +0, which indicates there was no range extension. And as you can see on the chart here, the price actually mean reverted. It went back. There was no specific range extension over here. Then we have 2 more metrics, which is distance from high and distance from low. What this tells us is, given the current price, where exactly in the range is it? So right now, if you see, it says 5.6% from distance from low and 94.4% from distance from high, which means it is quite close to the low. So if you see again over here, compared to the day low, the price closed pretty close to it. So during the day, at any point of time, if you track this, you get a sense of where the price is compared to the high or low. And it's useful, especially if you trade pullbacks. It gives you a realistic and real-time sense of how much the prices pull back from the high or low. Lastly, you see these 2 blue lines, which is nothing but a range marker. So at any point in time, these 2 lines mark the high and the low range for the day. And the yellow one is the ADR, which is a band based on the average past 5-day range. It tells you at open and from open the upper and the lower thresholds of the range. It's just open plus ADR by 2 and open minus ADR by 2. You can actually ignore it as it has limited use post open. The next indicator in terms of its purpose sits right in the middle, and it's both a broad trend indicator and a market structure indicator. That's TWAP, time weighted average price. TWAP is natively available on TradingView and it's not a custom indicator. Think of TWAP as a running average of the price for each time period. If we are on a 3-minute time frame, at 9:21 it'll calculate the average of 2 bars, at 9:30 for 5 bars, and so on. That's all it is in terms of calculation. This amber line, which is kind of trailing the price, is the TWAP. As it's a running average of the price, statistically its value and relevance increases as the day progresses because it gets to capture more data. I call it a broad trend because if it's sloping down like this, it means the price is trending down. And in this case, it is flat. And if the market goes up, it kind of trends up. From a market structure standpoint, it is a midpoint price of the day and hence a good level to look at for supports or resistances or trend changes. One of the reasons for us to use it is also because it works well on spot where we do not have volume information. Now we will move to the third indicator of the day. This one is a trend indicator. Let's call it an EMA based trend state indicator. What this indicator does is it tries to classify intraday trend into 4 states. So on the long side you have strong and weak, and on the short side again you have strong and weak. Intraday trends move from weak states to strong states and then back to weak states, and that's a cycle. To give you a sense of it, let's say if the market is going up, at some point it'll reach exhaustion, and that's a weak state. And after that exhaustion, there can be 2 things that can happen. Either the price continues in the same direction or the price reverts to the mean. But here's how it's calculated. This indicator uses 2 EMA lines with, say, a look back of 9 or 10 bars on a 3-minute chart, which I would say is a sweet spot in terms of time frames for scalping. A look back of 9 or 10 minutes captures 27 or 30 minutes, which is what is the average trend duration for intraday trends. Back to the trend state. In this indicator, one EMA uses candle high as the input and the other uses candle low as the input, in a way forming an EMA band. The green colored EMA is calculated using the high values of each of the bars, and the red colored EMA is calculated using the low of each of the bars. In a trending environment, which is during S1 or S2 segments, you will see once the trend starts, for instance, as you can see in this image, when the downtrend starts, prices will consecutively close below the red EMA. Till the time the price closes below the red line, it's a short, strong state. If the price closes above the red EMA, it turns into a long, weak. So, in a way, any close inside the band is a weak state, long or short. Likewise for an uptrend. During an uptrend, you will again see back-to-back closes above the green EMA. There is also a bar coloring logic based on the trend state. Fair warning again, we are not predicting trend here, and that's not the purpose of an EMA. This indicator just tells us the trend state so that you know if a trend is losing or gaining strength. Lastly, as with any indicator that has an aspect of averaging, it will always be slightly lagging. I designed this variant based on my observation of the market, but at the end of the day, any EMA or similar moving average should also work. Also, as we've looked at the data earlier, most of the days if you are looking for trend persistence, S1 and S3 are the time windows where the odds are greater. Now let's move on to the fourth indicator of the day, and it's a very simple and intuitive trend indicator. It's a Heikin-Ashi overlay indicator. It essentially plots Heikin-Ashi bars in a different pane. Heikin in Japanese means balance or average, and Ashi means foot or bar. This indicator was made popular in the Western world by Swedish trader Dan Wahlquist quite recently in 2004. It's a data visualization technique that eliminates irregularities in a normal candlestick chart and offers a clearer picture of trends and consolidations. Along with the color of the bar, the size also helps us determine the strength of the trend. As the candle bodies get smaller, it means the trend is getting weaker. And yes, typically ignore the first few bars at least for 15 to 20 minutes after open, which is anyways a no trade zone. After that, if you notice, the bar colors and the bar size of Heikin-Ashi chart do provide a visual confirmation of trend strength, weakness, and trend change. This indicator can help avoid taking impulsive counter-trend trades. Heikin-Ashi is going up and it's green, green, green. But here there is a lot of noise if you see. But if you just go by Heikin-Ashi, it at least helps you be in the trade and you won't take a short trade over here because the trend on Heikin-Ashi continues to be in green. Also, I do not recommend using Heikin-Ashi as a primary indicator or a chart type. That can mess up your sense of the current price. With that, let's get to the fifth and the final indicator for the day. I first came across this idea nearly a decade ago when I was reading about the McClellan oscillator and the summation index created by Sherman and Marian McClellan. And while reading about their indicator, a simple question occurred to me. Why can't market breadth be used to identify intraday trends? That question stayed with me, and over time it eventually took the shape of this indicator. For those of you who are new to market breadth or market internals, the idea is fairly simple. One must understand that the idea of market breadth is relevant only for indexes that are made up of constituent stocks. The logic is that by tracking how the constituent stocks are behaving, you can get a better sense of the strength, weakness, or sustainability of an index trend. A simple way to think about it is to imagine a general leading soldiers into a battle. If the general moves forward but the soldiers are not following, then that advance is fragile. Similarly, if the index is moving strongly in one direction but a meaningful number of constituent stocks are not participating, then the move may be weaker than it appears on the surface. In the US, traders have access to several live intraday breadth indicators such as NYSE Advanced Decline Line and NYSE Tick. We do not have the same ecosystem in India, so this is my attempt to build something that may still be useful in our context. Now think of it as a practical experiment, not a perfect solution. The indicator is based on two simple premises. First, an index moves because its constituents move. And second, in a market cap weighted index, every stock does not matter equally. A heavyweight stock has much larger influence on the index than a smaller constituent. With that background in place, let's understand the indicator. So for Nifty 50, which is a market cap weighted index and has 50 constituents, we first need to get the latest set of stocks and the weightages from nseindices.com. If you go to the monthly report section, you would find the data there. I then divided the stocks into three segments: heavy, mid, and light, based on their weightage. Heavy stocks are stocks with greater than 2% individual weight, and in total would have close to 62% index weightage. And there are 13 such stocks. Mid would have stocks which have 1 to 2% weight, and there are 14 such stocks. And then light tier would have the rest of 23 stocks which have lesser than 1% weight. Now for each of these three tiers or categories, we can calculate a cumulative net advance decline. Meaning, for each minute, we calculate the number of advances, which means the number of stocks that close in positive compared to their open, minus the number of declines, which is the number of stocks that close in negative compared to their open. Each advance or decline is also multiplied by the stock's weight in the index. That helps us get a weighted breadth of the index. And then we add all the advances and declines. This number is a running total, and if the number of advances keep increasing, the net will be positive and will lead to an upward trending line. And if the net is negative, it will lead to a downtrending line. This is how it would look like. The dark red-green line at the top is the heavy tier. Then the lighter one is the mid tier, and the blue-gray one at the bottom is the light tier. Now compare the index moves with these lines. It's almost as if you have opened the bonnet of an ICE car and checking out its engine while the car is moving. I know this could be getting complex, and hence I pause to check with you if you are with me so far. Okay, let's continue. Now, what we have done so far is we've calculated the advances and declines, or the advance decline line, for each of the three tiers. Next, we try to add a trend layer on the breadth calculator. We apply a TWAP on the breadth to see if it's uptrending or downtrending. Now, if the cumulative breadth is below its TWAP, it's downtrending and it gets colored in red. And if it's above its TWAP, it's uptrending and it gets colored in green. We can also use the tiers to mark the turning points on the main chart. So these are the green triangles, which are the crossovers of breadth, but it is being marked on the main chart. So what this means is at this point of time, the net advances kind of went above the net declines, and that is why it's a turning point. And from here it started, and then again at this point the trend changed. So here again it was kind of noisy and all that. One of the things that I have noticed is there are days where the mid tier is leading. So when I say there are days where the mid tier is leading, so what it means is there are times where you get this gray signal. This marks the mid tier going short, and then it is leading because this happened. The mid tier turned before the heavy turned here. So this is an example of mid tier leading the heavy. And then there are days when the heavy tier is leading. So what this is a good example where the heavy leads the mid tier. So this triangle comes first and then this. The blue marks identify that the mid tier is turning positive, and the green triangle marks exactly the same when the heavy tier turns positive. The good thing about this indicator is that it's not lagging like an EMA, as it's not a price-based indicator. At the same time, it can get noisy as well. Personally, I just take it as just another way of confirming trends and understanding index moves better. At the end of the day, you will get those 2 or 3 trends in a day, mostly in S1 or S3. You can take them with just about any trend indicator. In summary, in this episode, we explored 5 key indicators that can help us better understand intraday market structure and short-term trends while scalping an index like Nifty 50. At the same time, at the risk of sounding like a broken record, I repeat that indicators do not predict the future with any kind of certainty. All that they do is to organize past data and tell us what the market has already done. And at best, it can be used for improving our understanding of the probabilities for future. The broader takeaway is that no single indicator is enough on its own, but when used thoughtfully, they can give us a more reliable framework for reading intraday price action. That brings us to the end of this part 4 on scalping. In the next episode, we will look at how to use these indicators to make entry and exit decisions, and also how to specifically select strikes and use the spot as a base to trade options. I hope you found this episode useful and interesting. I know this was again a heavy episode with a lot of concepts, so do watch it again to get a better understanding. And as always, feel free to share your questions, thoughts, and feedback in the comments. I will do my best to respond. Thank you for watching and see you in the next one.